So some of your options when it comes to taking a loan against a whole life insurance policy are 1, to borrow directly from a life insurance policy, or 2, leverage it with a bank or lender to obtain a cash value collateral loan. Now there's pros and cons to both, and we're going to go through in this video today taking loans from a high cash value life insurance policy with a non-direct recognition contract, a direct recognition contract, and then also looking at a collateral loan. Because when it comes to whole life insurance, when a policy is designed for high cash value and someone is interested in the policy, so you're interested in high cash value, the death benefit may or may not have some importance to you, but you look at the cash value, you say, that's what I'm interested in. And we see this a lot with real estate investors and business owners where they say, hey, I love the idea of positioning some of my capital into this product because it's going to earn between 3 to 5%. The tax benefit is fantastic. I can access it anytime I want. But what I don't like, Steve, is the fact that I'm earning perhaps 5% at best. And when I look at the loan rate with the insurance company, it's 5%. Sometimes it's 6%. Now, some companies do have lower loan interest rates depending on the product and such, but for the most part, we usually see loan interest rates between 5 and 6% with most insurance carriers, specifically on whole life insurance. So when it comes to business or real estate, the topic of what's my interest rate, what am I paying to a lender, or if I'm borrowing from an insurance company, what am I paying to the insurance company? That's a sensitive subject, and we want to make sure that you have full transparency around what the loan interest is, what you're paying out of pocket, what you're earning on the policy. How do you put yourself in the best possible position? So we're going to take a look at a policy, the exact same policy, designed for maximum cash value. We're going to go through numbers like we usually do, but we're going to compare that policy then to taking a loan directly with a non-direct recognition contract, direct recognition, and the collateral loan. And again, this is the same policy with the same company. What I want to start with though is going through this information. So what we're going to start with is assume that you have a policy with a dividend rate of 6% and a loan rate of 5%, and it's non-direct recognition. Usually, when you see a non-direct recognition contract, it's true of most insurance companies that a non-direct recognition policy results in a variable loan rate. Not all companies. Penn Mutual is a good example. They have a variable loan rate, but they practice direct recognition. But if you look at the major mutuals, typically you'll see Mass Mutual with their variable loan rate of 5%. That gives you their non-direct recognition contract. If you select Mass Mutual's fixed loan rate of 6%, that gives you a direct recognition contract. Guardian does things a little bit different, but I'm not going to go through companies in this video. So let's assume you have cash value of $100,000. That's in your policy. That is earning a 6% dividend. Keep in mind that that's a gross rate, not the net internal rate of return. But if you're earning that 6% dividend and you just let your money sit and grow, the 6% dividend will occur on the entire $100,000. If you elect to take a loan out, let's call it at 5%, the 5% would go where? Anytime you take a loan from a life insurance policy, loan interest is paid to the insurance company. However, you will continue to earn that 6% dividend on the remaining $50,000 and also the $50,000 that is outstanding as if you never touched it in the first place. So with a non-direct recognition company, or contract I should say, if you borrow and then repay, you'll see your values 100% restored to exactly what they would have been as if you never touched it in the first place. So if this $100,000 was going to be worth $200,000 in 10 years, you take a loan of $50,000 out today and you pay it back within 10 years, you'll see the same $200,000 value in 10 years, exactly the same as what you would have seen as if you never touched it in the first place. Interesting how that works. That's non-direct recognition, meaning the company does not recognize the fact that we take out a loan. And I want to touch on another point too, because this is always important. I've got this word gross dividend rate that might result in a net earnings rate, internal rate of return, of, call it 4.5%. So this is specifically where the objection comes up, where an investor looks at his situation and says, okay, this policy is earning 4.5% and it's tax-free. That's fantastic. With no risk, it's not in the market, nothing like that. But at the same time, I look at that 4.5%, maybe it's only 4%, the net IRR, and I'm paying 5%. Like, I cannot justify that on paper. I'm just not comfortable with it. Don't try and sell me on it. Like, no, the numbers must make sense in order for me to use this for real estate deals. So let's continue on. That I just want to emphasize with the IRR there. But let's look at direct recognition now. So non-direct recognition. The main point is here is if you borrow directly from the policy, you will continue to earn the same dividend rate, again, a gross dividend rate, on your entire cash value as if you never touched it in the first place. Now let's pretend or assume that you have a direct recognition policy. What will happen here is, assuming you're earning the same dividend rate, let's adjust this actually to make it more realistic. Let's use Guardian's direct recognition treatment. All right, so Guardian has a 2021 dividend rate of 5.6%, and they have a present loan rate, a fixed loan interest rate of 6%. So how's that look on paper? Not that good. Why on earth would I do that? Does not make sense. Now, what Guardian does is, if I just have 100 grand in cash value, $100,000, I don't touch it, earning that dividend rate, which again is a gross rate, but I would earn that dividend of what? 5.65%. Now, if I elect to borrow against it, a direct recognition company, what that means is that they are going to directly recognize the fact that you borrow from your life insurance policy, and they will then adjust the dividend rate on borrowed funds. Here's exactly how it works. So you take a loan, the loan interest rate or cost to borrow is 6%. That again goes to the insurance company. Now, the money that you did not touch, the $50,000 remaining in cash value, because you only borrowed from half of it, you borrowed $50,000 of the $100,000, you're still earning the 5.65 on that gross dividend. However, on the loan portion, you're still earning a dividend. Here's what Guardian does. They raise the gross dividend rate to 6%. Which still might give you a net IRR of 4.5%. So you're still negative when you actually look at the numbers. And we've got other videos that really go into detail on that, which you can certainly check out if you haven't seen yet. My point here is, with direct recognition, the company is going to recognize the fact that you borrow and adjust your dividend rate. Some companies will lower your dividend rate on borrowed funds, some will raise it. What we found is the larger mutual companies, the ones we prefer, so companies that practice direct recognition that are among the major mutual companies, Guardian practices it. They also have a non-direct recognition option available at year 10, but Guardian practices direct recognition. Mass Mutual does have a direct recognition contract, and then Northwestern Mutual does as well. New York Life is strictly non-direct recognition. But here we go. Those 4 companies raise your dividend rate on borrowed funds, those 3 companies I should say, with their direct recognition. Where non-direct recognition, don't matter. Then you've got a cash value collateral loan. And what I'll add here is, if you are using a whole life insurance policy to position some of your capital, grow it safe, liquid, tax-free, and have a death benefit, and you're leveraging cash value collateral loans, doesn't matter if you have a non-direct or direct recognition company at all. You don't have to look into any of that. And here's why. How this works is, if you have the same $100,000, you would not borrow directly from the policy. What you would do is actually take the policy to a bank or a lender and assign your cash value or a percentage of it to that bank as collateral. They then give you a loan, typically in the form of a line of credit. There are terms there, and again, we've got other videos on that. But my point here is, all of your cash remains in the product. You're not pulling it out in any way, shape, or form. If you default on your loan, then the bank has access to it because there's an assignment against it. But with that said, they give you a line of credit, a lot like a HELOC. The difference here, now you have a cost to borrow, that may be around 3%. That does not go to the insurance company like a direct policy loan would go, but instead goes to the bank or lender. And there's pros and cons to both. To simplify, direct policy loans are very flexible. You have complete control over how and when you pay them back. You don't have to make interest payments each month, whereas with collateral loans, you do have to make interest-only payments each month, and then you can apply principal toward the balance at your discretion. You can just throw money at the balance. But those are some different options. However, what do you notice here as far as the interest rates? If you pick that up. Here was 6%. Over here it was 5%. You could argue, hey, non-direct recognition usually gives me a lower interest rate, which is the case with most companies, but again, not all companies. But what do you notice? Insurance companies, 5 to 6%. We're going to show you a non-direct recognition in the example here at 4.5%. But what's the collateral loan? 3%. Some lenders even go lower than that. Some are a little bit higher. It depends on how much cash value we're assigning to the lender for a line of credit. My point is if you are an investor or a business owner that puts a lot of value on the interest rate because maybe you've got $1 million or $10 million in cash value that you're leveraging, now all of a sudden 3 to 4 or 3 to 5 to 6% makes a huge difference. That's where I want to really put emphasis on that and think, okay, now I'm concerned about the actual cost to borrow as I compare that to my return on cash value. So in the next video, we are going to go deep into the numbers, compare these three side by side. If you enjoyed this video, please click the like button, subscribe, and as always, I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.